Thank you, Peter. Thank you, everyone, for being here this morning with us. Good morning. It's an absolute pleasure for me to be here to talk about what I'm doing for my job, but it's also part of my passion, quantitative finance and quantitative strategies. So probably this presentation will be slightly different to those who came before me. Here, what I want to share with you is my experience of how people are using in practice quantitative strategies and quantitative techniques to actually invest in financial markets. So that's going to be a very practical and applied talk. And I hope you'll get many questions after that. I would be really happy to share with you my experience here. So what I wanted to do today is to briefly go through quant investing and all the different strategies and the major milestones that you can hear here and there about this topic, from traditional equity factors to machine learning. So there'll be a lot of subparts in this talk. We'll look briefly at why are people looking at systematic quantitative investing today. We'll go through the history, and then we'll go through a lot of those iconic strategies: equity factors, trend following, risk parity, risk premia, tail risk hedging. What do they mean? How are they being used? And what are the various debates, both on the academic world and the practitioner world associated with it? But first, why systematic quantitative investing? We're in 2021 after a major pandemic. In the middle of a major pandemic. It's not over yet. And there are quite a few challenges for investors. And some investors are turning to quantitative strategies and quants to find answers. So one of the main challenges that investors are facing is bond yields. Bond yields that are at a very low level. They've started to increase back to their levels in early January, in early 2020, in the US in particular, but still on a historical basis, levels are super low. So the main question that we face from investors is, if I run a 40-60 portfolio, which means I'm mixing equities and bonds, and I'm hoping that my bonds will help me diversify my equity risk in a downturn, how do I do if yields are at the zero floor and yields and bonds don't add diversification in my portfolio anymore? So how can I hedge that? And we will see that systematic investing can provide some answers. Second questions is the question related with carry. Carry is one of the most ancient trades in financial markets. So it's akin to an insurance policy. You're selling a form of an insurance premium, and you're collecting a premium for that. So you're collecting some carry. Think about selling volatility, for example. Or you're lending money to an insurer long term, and you want to be paid for having your money being lent to that insurer and being not available to you. So this is a form of duration premium. It's also a carry trade. There's a lot of different carry trade that you can find in financial markets, but at the point where we are here today in 2021, all those carry trades are very compressed. By that meaning that you're not getting paid very much for the risks that you're taking. So typically, if you're lending money to the US government, you used to get a nice 5-6% premium for lending your money to the US government. Now you're getting something like around 1.5% for a 10-year lend. So that is causing problem. On top of that, you have inflation. We have the latest CPI fixing in the US at above 4.5% yesterday. And inflation is eating away that carry that you can earn, because in real terms, that carry is in most of the cases negative. So how can you earn yields? How can you earn carry that will be positive in nominal terms? Some people again are turning towards quantitative finance because quantitative finance and systematic strategy have that capacity of finding carry opportunities outside traditional assets in area of quantitative finance like volatility, option markets, Q premium, vol premium, dividends, repo. So there's a lot of different niche in financial markets where carry can be extracted and carry is still attractive. A third challenge that investors are facing is the risks of higher yields. And in a way, this is a risk that have started to materialize since the start of the year, with US yields rising from 0.6% last year, at the end of last year, to 1.6% today. It is a risk in bond markets, but it's also a risk in equity markets. And that is a very important point here, because very often people don't realize that you have a lot of bond risk hidden away in single stocks. And here is a chart that illustrates my point. So here what we're doing, we are looking at a global universe of stocks, and we're calculating for each of those stocks its correlation with US Treasuries. And then we're ranking those stocks according to that correlations with US Treasuries. And then we cut those stocks by quintile, and we look at the quintile that benefit the most from rising bond yield. So all those stocks that are the most positively correlated with bond yields. And we also look at the opposite quintile, which is the quintile, all those stocks that benefit most from falling bond yields. So we create two baskets. That's about, say, 200 stocks in each basket. And then we calculate the average price to book of that basket. And this is what those two lines shows you, the average price to books for the stocks that are the most correlated to bond yields and the most anti-correlated to bond yields. Price to books is a measure of valuation. The higher that metric, the more expensive stocks are. And what you see here is something that has never happened in history before. You have a massive valuation gaps between equities that are positively correlated with bonds and equities that are negatively correlated with bonds. So that's the red line are all those stocks that are positively correlated with bonds. So there are these defensive stocks, quality stocks, growth stocks. Think about Apple, Facebook, Amazon's, all those guys. They are, in the recent years, they have become what people call sometimes bond proxies. So they're a form of safe haven. Conversely to that, you have cyclical stocks. Think about automotive industry. Think about banking. Think about commodity stocks. They're generally known as value stocks, and I will come back to this concept in a moment. And here, courtesy of quantitative easing and bond yields going so low, you also see this massive gap between bond proxies and cyclical stocks, which means that in an environment where rates are rising, you're going to see a correction of that gap. And this is something that is currently materializing. We see a massive sell-off of Tesla with, for example, financials getting a little bit better. So that is going to cause some performance problems in portfolios and even in equity portfolios. So one of the questions that is being asked to quantitative investors in a way is, how do you hedge portfolios against that? Imagine you have an asset manager who have a high exposure to growth stocks, and now bonds are rising. The market at the S&P level, at the global level, is relatively stable, but you have this massive factor rotation within the equity market. So how do you do to hedge that? This is another challenge that we're trying to address. So a lot of different things happening in financial markets. And the good news is, with the advent of systematic investing and index platforms in banks, investors have access now to strategies that used to be the bread and butter of hedge funds. But they have access to those strategies as off-the-shelves investment in a way, or off-the-shelves product, so that they can pick and choose the problem that they want to solve in their portfolio to add some quantitative strategies. So what are those strategies? That's what we're going to see. But before, maybe just a brief recap of the evolution of asset management and what took us to this point in time. So if you think, if we go back to say the 50s, 60s, there were no very much differences between different concepts. So people were trying to bring together portfolio as a whole. Now, the turning point's been probably the work from Markowitz and the CAPM theory, where researchers have started to differentiate between market beta and alpha. So market beta is more or less the returns and the risks that you get by investing in traditional assets, equities, bonds. And the alpha is the excess return that an asset manager is able to bring compared to the market because of active management, managing skills, advanced model, machine learning those days. So that this is what we call alpha, the excess performance compared to market. Now, after the work from Markowitz and the CAPM theory, there's been a refinement of the theory, lots of work from researchers along the line of Fama and French, and people started to identify biases in a way, or risk premia in the equity markets, things like value, quality, profitability, growth, quality, and that's those Fama French factors were the first systematic way to overperform standard markets. And then as we went along, this concept of factor investing and trying to find systematic alpha in the market extended from the equity market into other asset classes. And now we're talking about factor investing in commodities, currencies, bonds, and credit, bonds, government bonds and credits. So, and that led to something called alternative risk premia, which have been very popular and started to be very popular from 2015 onwards. It's still a topic of discussion. And this is a generic term which encapsulates, if you want, all those excess alpha that one manager can monetize through systematic rules. And today we have beta, equity risk premia, alternative risk premia, and ultimately we still have a little bit of alpha, which is the excess return provided by a portfolio manager outside of all those systematic strategies. Now, something that has changed over the past few years is there's a lot of quantitative strategies out there, and those quantitative strategies are making the headlines. So you probably have heard about risk parity, trend following, tail risk hedge funds, risk premia, equity factors, factors in fixed income, intraday trends. So all those things are being more popular and are being popularized by the financial press. So Quant is very much in fashion, and you can make the headlines if you're a quant investor. So that's a little history of quant investing and where we are now. Now, equity factors is probably one of what we call the grandfather of all styles. It started so it's probably started in the 60s. So as I mentioned already, with the work from Markowitz and the CAPM, the capital asset pricing model. In the 70s, you had the first researchers which started to talk about low volatility biases. So the fact that low volatility stocks tend to overperform the market. In the 80s, you have a seminal work from Basu in 1981 who showed that low PE stocks generate higher returns than high PE stocks, which is really the grandfather of value investing. And then in the 90s, you had Fama and French defining the size and value factor, momentum factor in 1993. The work from Kehart in 1997 with a 4-factor model to improve performance compared to the market. That brings us to the 2000 years. The great financial crisis has been a turning point in terms of portfolio construction here in equity factors, because in the post the great financial crisis, people realized that traditional assets has the propensity of recorrelate themselves in a crisis. So some pension funds and sovereign wealth funds led by people in the Nordic countries has started to reorganize their management sections and to think in terms of factors. So this is a work that has been spearheaded by Norges Bank in particular, where they and Andrew Ng and other colleagues, where they started to think in terms of, okay, rather than trying to invest in market per asset class and have portfolio managers per asset class, let's think about markets in terms of factors. And I'll get back to that concept. And then in the 2010s, we had even more factors appearing, and some people pinpointing the term factor zoo. This is how many. This is a term that reflects how many factors we have in the equity world. There's so many factors that now there's a factor zoo in the equity world.
I have a question, Sandrine.
Yeah.
I noticed all your factors have names, and typically named factors are correlated. So what's your thought about whether, we can include in the name factors things like principal components, which are by definition orthogonal?
Yeah, this is something that it's a very good question, and thank you very much, because that brings me directly to my next slide.
Okay.
So the way that you define a factor is you take a metric. There is a metric of a stock. So say you take the EBITDA ratio, or you take the price earning ratio, or you take the beta of your stock with the market, or you take the realized volatility of your stock. So each of my points on the graph that you have under your eyes is an indicator. And what you do is that you take those indicators, you rank them from the highest to the lowest, and you look at the top quantile versus the bottom quantile. So this is what we do in the equity factor world. We rank things, and we look at bottom versus top quantile, and then you derive a performance track. So imagine you regularly take say the EBITDA ratio, you rank your stocks according to your EBITDA ratio, you construct a long basket and a short basket, trading the top and bottom quantile of those stocks classified with the EBITDA ratio, and you do that regularly, then you can backtest the performance of that basket. That gives you a time series, which is the performance of your factor. That time series, you can then compare that time series with the time series obtained with other different factors, right? If your indicators are correlated, meaning if they indicate the same type of fundamental behavior of the stock, then the performance of those factors should be correlated. So here what we're doing, we're not doing a principal component analysis, we're doing what we call a minimum spanning tree for each of those factors. So the performance of ranking the stocks according to a factor. And we look at how things are clustering themselves.
Okay.
And effectively, Peter, you're right in the sense that they're correlated and they're grouping. You can group them in styles or in ideas or in concepts. So, for example, on the left-hand side here, you have lots of different ways of measuring momentum in stocks, and all those different ways of measuring momentum in stocks are grouped together under a form of momentum bucket. If you look at things like volatility, the Mertens distance to default, the KMV type of metric, the beta of a stock to a market, a metric that measure earnings quality, all those things, they behave more or less the same, and they define what we call quality stocks. At the bottom of the graph, you have things like sales growth, earning per share growth, ROE, ROA, ROIC, all those metrics. Again, if you classify stocks based on those metrics and you trade that, you will obtain strategies that are correlated. This is your growth factor. And same thing, you have carry based on yield and forward PE or PE. You have value and size, which depends on the small cap versus big cap. So in essence, we're using 80 different, in our research, we're using 80 different metrics. So 80 different way of specifying or of qualifying a stock. And we backtest those 80 different metrics, and then we group them in big buckets. You could do a principal component analysis, you derive to the same type of clustering. Now you have to make a choice, and what equity quant usually do, they do those type of statistical analysis, and they decide, okay, I'm going to create a value strategy based on different indicators. And it's a choice that is made ex post. It's very ad hoc choice. This is an example of choice that can be made. So for example, the way that at Société Générale, we define the value stocks. We look at the stocks that are very cheap according to a different type of metrics, book to price, earning to price, 1 year forward earning to price, etc. You also have a quality factor, a momentum factor, and a profitability factor, and you can expand your factors as you go.
Yeah.
This,
can I just jump in? I mean, so say hypothetically, I hired a complete rookie to go find factors, and they first proposed, let's say, value, and then the second factor they proposed was 2 times value. Okay, like nobody, in finance would call 2 times value a second factor independent of value. Okay, but how would, and you wouldn't either, I'm sure. So we're sort of getting into, so what exactly, deserves the name factor? Like, so we mod out, let's say, scaling by 2. What else do we mod out? I mean, anything, or so like a minimum, you mentioned you're using a minimum spanning tree to find factors, and that's a very concrete answer, which I appreciate. And so the minimum spanning tree, if it was presented, with both value and 2 times value as potential factors, it would just treat them as the same, right?
Yeah.
Okay.
Yeah. In this case, it's completely collinear. So you'd have something to label that would be almost next to each other. I guess.
Peter.
Yeah.
I would just to comment on that about. I mean, is it sort of similar to when you look at an econometric model where you say it's independent variable versus dependent variable? So as Peter says, if you have 2 times the value factor, that's still an independent variable, but but 2 of them would be correlated. So you wouldn't put X and 2X into the right side of the equation, correct? You'd say, so are you saying that you have to look at just the similar thing to independent variables? Is that what you're really saying when you look at a factor? It's an independent variable as you do it for for
Yes.
for a regression analysis.
Right. And so let's say
Right.
we introduce value and size, and let's say they're independent, which is how we think. And then you introduce a third thing that is nothing but 2 times value plus 1 times size. And so a linear combination of the 2 existing independent factors. Then of course, this third thing would also not get counted as an independent factor because it's not linearly independent of the 2, previously linearly independent factors. And so I think we're all agreeing that in order for something to qualify as a factor, it has to increase the span of the space. Is that right?
Yeah.
Okay.
I think there's also something else going on here.
Okay.
Which is the fact that, these factors have meaning. They have economic meaning. And you look at volatility and it has whatever, meaning. And then you look at 2 times volatility, just exogenously, because you studied finance, what these things mean. And that, earnings per share, that's something different than beta. And
Yeah, agree with you, Ed. It's Ed, right?
yes.
So yeah, I agree with you, Ed. There's a like what is behind all those factors concepts is deeply rooted in fundamental analysis.
Yeah.
So you look at things that equity analysts are using to analyze stocks and decide on buy or sell, and use that as an input to your model. But the way that you assemble factors or define factors is left to the modeler choice. So there's a high degree of
well, to some degree, because Peter was talking about principal component analysis.
Yeah.
And what happens when you do a principal component analysis is you get some weird linear combination of the things that you think are important, and it's not obvious necessarily that those things have meaning. And this really matters to me, and this is something I've always wondered about any of this stuff, which is the fact that markets are non-stationary. So
Ed, your comments, it applies for years for people doing econometric models. The same thing, the same problem, right? I mean,
yes,
doing
I think
large scale econometric analysis, the same problem in terms of the variables of the data set. That's nothing new with that. I guess the same issues that arose for many years in trying to do accurate econometric models of the economy or of the macro system. So you're right about that.
One of the big problems is that most of the academic papers look for factors that have good in-sample explanatory power, that explain the cross-section. And most practitioners are looking for factors that have good out-of-sample predictive power. And so I think the main test from a practitioner's point of view is, if I add this factor, will I get better out-of-sample predictive power? And sometimes those two, more in-sample is overfitting, and out of sample is a whole different thing. So I think Campbell Harvey has looked at what he calls the factor zoo of all the factors that are out there, and he concludes that almost all of them are ineffective and have no statistical power out of sample.
Yeah, thanks a lot for making. One of the things very often is that all that exercise of looking at factors that we think are fundamentally driven and we hope are decorrelated, or they bring information to the data set that we have already. This is namely a data mining exercise. Right. So if you think about that, you're trying to look at a lot of different metrics. You're looking at the performance of trading those metrics, and exposed, you're saying, okay, this metrics gives me a good performance, and I can understand why, because stocks are cheap, so I'm buying cheap, and I'm going to make money over the long run because of that. So it's a data mining exercise where you try to find exposed explanation. This is my way of looking at factor definitions, the traditional factor definitions. Now, as soon as you pronounce the word data mining, people start to get suspicious. But there is nothing bad with data mining, because we all do data mining in science. We all try to learn from our data set. But the thing is that in today's world, we do have nice tools for mining data. So, and that takes me to my next stage. So one way of thinking about equity factors is to go for a full-fledged data mining model. So you acknowledge the fact that equity factors, it's about trying to find indicators that are able to explain the cross-sectional performance of stocks. And you need to find, using all you know about statistical learning, you need to find good indicators. And the good news is that there are plenty of algorithms available there. So sorry, the slide is a bit small. So here it's a sort of recap of all the different machine algorithms, machine learning algorithms you can use. And based on that principle, we've done a little bit of an experiment, if you want. So we picked one of those techniques with my team, and we tried to see how we can apply machine learning to identify factors which are effectively able to bring value in the future, and not looking at just the past and trying to analyze the performance exposed and trying to make sense of it, but trying to anticipate factors that might be better at forecasting the cross-sectional performance of stocks.
At this point, excuse me, I'd like to ask a question.
Yeah.
Which is that, you know, before you were talking about linear factors. So you'd be in a situation where you have some factor, and if you'd like to see more of that factor is better, let's say. And then you have another factor, well, more of that factor is better. So, you know, if you have more of these two factors, that's even better. Now, the thing that, so far as I know, at least neural networks really do for you is they allow you to deal with situations where factor A is good, factor B is good, but the combination of them is bad, or vice versa, where you have factor A being bad, factor B being bad, but factors A and B is good.
Yeah.
I was just wondering if you have examples of that sort. Well, apparently you found examples of that. I was wondering if you have some specific examples.
Yeah, there's a, I mean, here we are talking about things like nonlinearity or conditional behavior. So, or in a way, regimes. So markets are exposed to some form of regimes. So, for example, if you look at linear factors, you cannot take into account that in a low volatility regime, some factor might be better. In a higher volatility regime, some factors might be better.
Okay.
So we are, in a way, what we're trying to bring here through the machine learning model is a sort of multi-dimensional nonlinear regression, where we're using past indicators to try to predict relatively short-term future returns of stocks. I mean, we're not using neural networks here. I mean, it's neural networks are still relatively challenging in finance. We're using boosted trees. So we are hierarchical decision trees, which are weak learners. So we're using boosted version of that. And we let the model decide what factors at any point in time is best to predict a good performance over the next future. So it's really this sort of asynchronous, multilinear, multivariable, multivariate, nonlinear regression that we do. My presentation wasn't about that. So I haven't brought more material,
Okay. All right.
but I can send you I can definitely send you some research on that if you're interested.
Yeah, I might like to have a quick look because, I mean, this starts to address this issue of non-stationarity because it's possible that, you know, as you say, well, sometimes they're high volatility regimes, sometimes they're low volatility regimes. That would give you a non-stationary
Yeah.
thing. But if you know the rules in each of them, well, which you're trying to get at, then okay, then you're getting somewhere.
Yeah, that's exactly the sorts of, you know, convex behavior that you can see.
Yeah.
And that's exactly what we're trying to capture here. Could be decision tree, could be neural network.
Yeah.
It doesn't really matter,
Right.
I think. What we've tried here was decision tree.
Okay.
So a word on the experiment. So this is what we had when we did this research. It was in 2016, 2017, yeah, end of 2017. So we sort of constructed our machine learning models, combining all the indicators that I mentioned earlier. And the model basically is telling at one point in time, you need to trade value stocks, and at one point in time, you need to trade quality stocks. The way it does that is because it chooses the feature value as the best indicator to predict the future return of stocks. So obviously, we were very happy about the results of our model, and that the question and the reason why we've done this work is because as soon as you start to talk about machine learning, you get a fair amount of suspicion, and you get a fair amount of you have so many parameters to fit and to choose from that you expose yourself to a fair amount of overfitting in a way. So you have the risk of overfitting your models. Obviously, you control that overfitting through cross validations and all different sorts of techniques. So to sort of avoid, to circumvent these critiques, what we've done is that we've launched an investment solution back in 2 years ago based on this technique, and we let the algorithm run. So what I wanted to share with you today is the results of these experiments. So what happens if at one point in time you decide on a machine learning model to trade equity factors and you let the machine decide out of sample, and it's a true out of sample experiment. And the answer is this one. So this is what we got. The point is, the past 2 years have been very challenging for equity factors. If you think about hedge funds trading equity factors like AQR and other quants, they have had a very bad time. It's the red line here. And the black line is the outcome of our machine learning model, where we try to trade those factors using a statistical learning methodology, basically. So the answer is you're not trading, you're not transfer with all those machine learning techniques, you're not going to transform lead into gold. You're not going to completely change the return profile of your strategies, but you're making better decisions at point in time. So in an environment that have been really, really challenging for equity factors, using a form of machine learning based methodologies allows you to arrive to something that is relatively bad.
Is 100 the 100% of what you started with, and so the idea is basically you're flat for these?
Yeah. So what you're
Okay.
saying here is like if you would have given me $100 in December 2018, I would have more or less given you back your $100. Well, for the equivalent style with other asset manager, you'd have lost $20.
Yeah. Okay.
So we are working with a data set that is relatively challenging for equity factors, but we are showing that by doing these sorts of statistical learning exercise, you manage to add value. That brings us back to my point that at the end of the day, we are doing data mining, but we're doing better data mining.
Sandrine, can I ask a question? This is Leon. Can I ask a question, please?
Yeah.
Would you say that in these comparisons here, that as far as the frequency with which the machine learning technique modified the selection of factors on which stocks were chosen, was that much more frequent in the black than in the red, in terms of, let's say, like, it's a question of, maybe turnover is the wrong word, but in other words, the idea is that over this 2-year period, the factors that are dominant that determine the composition of the portfolio, of course, are changing. But are they changing more frequently in the automated machine learning strategy than in what you're labeling traditional quant? See what I mean?
Yeah, traditional quant tends to be relatively static. So they'll have a relatively static allocation to growth, value, low vol stocks. So they can rotate within a style, but they have a static allocation to each style. The machine learning model is much more dynamic in that sense. So you get a lot more turnover in those type of models. And from a practical perspective, this is one of the great challenge that we had, how to control the turnover so that it becomes tradable. And that comes with a massive performance overhead, because obviously if you can trade very, very frequently, then you get a much better outcome, but that's not possible because you have trading constraints, volume constraints, and those sorts of things. So yes, you end up trading a little bit more. But I don't have, unfortunately, I didn't bring this chart in here, but if you calculate the exposure of the machine learning model to each individual factors, so say you're trying to calculate the percentage of stocks in the machine learning model that belongs to the value factor and the percentage of stocks that belongs to the quality factor. So that gives you a sort of a strategic idea of how the algorithm invest in financial market. That tends to be relatively persistent. So you see variations, but it's not overnight variations. It's going to be variations that occur over 3-6 months, something like that.
Sandrine, sorry. I suppose you also control for transaction costs, because I suppose the machine learning portfolio may change significantly.
Oh yeah, definitely. We control for transaction costs. We control for event stock events. We control for everything, because what I'm showing you here is live. It's a live strategy. It's something that is being traded. So we do have AUM on that. And you get a massive performance overhead when you go from something that is completely theoretical, and then you start to add trading constraints like costs, like liquidity constraints, and then you start to reduce down quite dramatically the performance of your algorithms.
Okay, thanks.
Can I ask quickly a question regarding this graph, please? What I see here is that your model, machine learning based model, has a flat return on this graph, and what you call global traditional quantitative models simply has losses. But people made tons of money after March 2020, after this falling market. What does it tell us? What does it tell us actually about the usefulness of all this? And I'm sure that the guys who made a lot of money used some quantitative models, maybe purely momentum models or whatever. So my questions, I guess, is what about practicality of this approach?
Yeah, here I'm pinpointing one particular style, which is equity long short. I should have mentioned that before. So you're really in the world of those funds who are market neutral, because you're going to trade those factors on a long short manner. So you're not being lifted by the market beta. And this is one of the problem with those funds, is that people who have made money in last year, there are people who are actively trading a beta position on the market. Here we are trying to make money outside the beta of the market, and that is relatively challenging. That is more challenging than making money by taking exposure on the market beta.
Sandrine, a question, please.
Yeah.
It looks like from the beginning of your time period till around, say, October of 2019, the correlation of the two strategies was pretty high, except for the divergence around March. Did you investigate what caused that divergence?
That's a good question. I would say what happened in March is that a lot of low volatility models or low volatility factors were very deceptive. So historically, if you look at the low volatility bias in equity, it has what we call a defensive stance. By that meaning that low volatility stocks tend to overperform in a crisis. And so if you run a low volatility factor, then you tend to do well in a crisis. What happened in March is that all the low volatility factors, which were constructed at the global market level, failed to deliver. So they lost a lot of money. So lots of traditional quant models were relying on their allocation to low volatility factor to diversify away from this crisis risk that they were having. One of the reasons why the low volatility bias didn't work as it was working in the past in March 2020 is because most of the low volatility factors were including financials, because financials tends to be low volatility stocks, so they had a sector bias. And that sector bias caused a lot of damage because in March 2020, financials were heavily impacted and underperformed quite strongly the market. So that you have some factor construction choices that are associated with traditional equity factors that have weighted on their performance. And when you run a machine learning model, you don't have those biases in your construction model, because you let the machine decide, and the machine is deciding on objective statistical criterion. And so we didn't have this financial bias in the machine learning, and that's one of the explanations.
Thank you.
Okay.
Can I ask a question as well?
Yeah. Yes, Sasha.
So I've been teaching FAMA French over the last couple of years, and I find that it hasn't worked in the last 2 years. In other words, small minus big loses, high minus low loses. So basically, the trend in the last 2 years is the rich are getting richer and the poor stay poor. You know, it's sort of a divergence kind of effect, or so, and things like value don't work, are reversed. And so I wonder whether that's not an explanation of these last 2 years giving this type of funds a hard time. And then the question might be, out of a pandemic, do these things sort of reverse? Do the little guys start, you know, outdoing the big oppressing Facebooks and Googles and whatnot? So I'm kind of curious about your long-term view on
Yeah.
factors.
Unfortunately, I don't have a crystal ball, but
no, neither do I. But for example, does my story explain this sort of?
Yeah, you had. There's
high,
definitely there's been a shift of regime over the past few years. So that, I mean, back to maybe it was Ed who was making the point of, you know, those factors work historically and those don't work, have stopped working. What I'm saying here is that they worked historically because we've looked at them on an exposed basis, and we've back tested them, and we realized they were working. And exposed, we said, oh, we're happy, we understand why they're working. And so sometimes we don't understand why they're working, so we say it's a bias, it's a low-vol bias. It's and will that revert going forward? Well, it's yes, probably if you have like big valuation gaps, they will converge. Will have some form of mean reversion, but will they keep on performing as they had been performing before? I just don't know. What the only thing I know is that if you're using a statistical learning method to try to learn what indicators is good to forecast the future returns of the stocks, then you might end up with a better outcome. And this is what the experiment shows here. I don't know if that answered the questions.
Yeah, it does. Thank you.
Oh my God. I mean, I had so many questions on that slide. And we have 10 minutes left in the presentation. So so that's the first big equity style that I wanted to mention today. Another factor, another style, another very classical strategy in financial market is trend following, obviously. So trend following is a well-established strategy in the hedge fund community. I gave a few numbers here. You have about 300 billion under management in 2020 in this strategy, and it has been quite stable. So you do have a lot of people who have trend following strategies in their portfolios as a diversifier and as a complement to their existing strategy. One of the reasons why it's been popular is because, well, it's allegedly a good performing styles over the long run. Again, we look at performance metrics. Lots of people have been publishing on that. AQR, CFM in Paris. You have even Winton, who looked at trends over centuries. And there's an evidence of this trend effect, which is linked to behavioral finance and the fact that people are more having a herding behavior. Now, why do you need trends in your portfolio? Why people are like trends is because this is a strategy that tends to be convex. When you're playing trends, this strategy is very much akin to mimicking the payoff of a straddle, so of a long put and long call option. So you have this capacity of earning money when stocks or markets are going up, and you're also earning money when stocks or markets are going down, because you have this capacity of shorting. There's a lot that has been said about how to construct trends. In essence, what you need to do when you want to construct a trend system, you need to define how you measure trends. You have a lot of technical indicators out there: moving average, crossing of moving average, regression line, option replications. I mentioned that, ankle gauger, threshold breaker, curve slipper, and I could mention a lot more out there. The thing that I wanted to say here is that in our research, we've done a lot of work trying to test which measures of trend was better than another one. What we found out is that this doesn't really matter. What matters is the time window on which you're measuring the trend. So you could take any of those metrics and you can compare them with using a very simple signal, which is if the past return is positive, you buy. If the past return is negative, you sell. If the past return is zero, you do nothing. That is a very simple way of measuring the trend and trading the trend. That works as well as things that are a little bit more complicated. The thing that really matters here is the time window. On what time window you're measuring your trends. So do you think the past week trends is the best indicator for the next week trend, or do you think the past month trend is the best indicator, or the past year trend is the best indicator of the future? The nice way also about using a simple signals like the one I've stated here is that you can start to do a little bit of math, and that's something I wanted to share with you here. Because I spend a lot of time in finance, and I haven't seen very often an arcsinus function. So I like this formula very much because the arcsinus, and I love trigonometry. And so what does so we did a bit of research on how do you choose your time window on which you want to measure your trends. And that's a tricky question because we are back to considerations like on what time window do you get the best performance, which is a very weak argument because that is the argument that leads you to overfitting. So here we said, okay, let's try to think out of the box, and let's try to find another argument, which is a diversification argument. Because if there's one thing that works in finance is diversification. So we said, let's try to find the optimal spacing such that we maximize our diversification. How do you maximize your diversification? You make sure that the correlation that you get between different strategies, between different signals, are small enough, because that small correlation means more diversification. So what we've done here, we derived the formula. So we assume that the underlying variables were following a Brownian motion, so Gaussian variables. We assumed that our trends were our trend system was constructed using these this trading rule. So if the past return over a given time window is positive, we buy, etc. And by doing that, you can simply derive the correlation between two trading rules, which is trading the trends on two different time windows. So here in my formula, NI is one window, NJ is another window, and I'm calculating the correlation between the performance of the strategy that follows the trends over a period NI and the strategy that follows the trend over a period NJ. And you do a little bit of algebraic manipulation, and you arrive to this fantastic formula. So what does that formula tells us? It tells us that the correlation between two trend strategies with different time windows depends on the ratios of the time windows, which is really cool because now you have you can derive a spacing rule. You can say, okay, maybe I want to start trading 1 week trends, or maybe I want to start trading here in my example 1.5 months trend. And if I trade 3 months trends, 6 months trends, and then 1 year trend, I know that all my strategies will have the same correlation, and I'm able to calculate the correlation of those strategies theoretically. And we've done a lot
I have
of,
a question.
yeah.
What keeps the correlation between -1 and 1 here? Like I'm just saying the arcsine function is actually real valued, right? Like the output is real.
Yeah.
So
arcsinus goes into -1 and 1, no?
Yeah, minus pi over 2 to pi over minus
sorry,
pi over 2 to pi over 2.
Yeah. Sorry, I was thinking.
Well, the thing I
no,
guess,
I'm thinking. Oh yeah, sorry, I was thinking hyperbolic sign.
the thing I guess I don't understand is I would have thought that, you know, each random walk is, I mean, you're looking at the same random walk at different time periods, effectively, right?
Well, actually, let me rephrase my question. so as Leon correctly said, arcsine is between -1 and 1. So that means right?
Minus pi over 2 and pi over 2, Peter.
Ah, never mind. I retract my question. Go ahead. Okay. Sorry.
What I'm
All
trying
right.
to figure out
No
is I
worries.
would have expected these the random walks to be completely decorrelated, and so, or the different increments to be completely decorrelated. Oh, but there's overlap. Is that
Yeah,
the
there's
point?
overlap, exactly.
Yeah. Okay.
The overlap of your time windows creates autocorrelation.
Right. Okay.
And it's not only overlap of the different time windows, but as you're trading,
Yeah.
you also have overlap between your trading signals and your past window.
Okay. Right.
So and the table below, the table at the bottom of the formula shows you. So we've done a little bit of experiments there, comparing the difference between our empirical correlations and the theoretical correlations. Obviously, assets are not a Brownian motion, so you don't get the exact value, but we're not that far. So we are it's a sort of a neat and nice results that I wanted to share with you on trend systems here. And that's it. So you can, I guess you can, once you've constructed your trend following mechanism, it's relatively easy to construct. So you aggregate the signals according to different time windows, and then you aggregate them across assets. Probably something that I've learned by looking at trends for the past few years is that you get a real diversification benefits by looking at trends across different assets. So you have periods where you're going to get trends in fixed income. So for example, at the moment, yields are continuously going up. So that means that trend following are having a good time because they are shorting bonds. But there are times where bonds are doing nothing. So there's a real interest in trying to find out ways of timing trends or understanding why an asset class is trending versus another one. I don't have the answer to that question, but that's in a way an open question for me. Is if I have that capacity of trading trends across different markets, how do I find if one market is trending versus another one? And how do I strategy allocate to that? So maybe machine learning is an answer, but haven't worked on that yet. So if any of you guys have any idea, I'm really open to it. So I'm conscious of time. I think we've largely overrun.
Yeah, well, that's okay. I just wrote someone, I'd rather hear half a talk that I understand than a whole talk that I don't. And this is definitely, you know, I've understood a lot. So thanks very much. It's a terrific presentation.
No worries.
Yeah.
Maybe I'll just do a word of conclusion, if I may. So what is the rest of the presentation was on other styles. What is the future for quantitative investing or what I think is the future?
Okay.
To go back to one of your questions, I don't have a crystal ball, but I can only share my thoughts there. What we're seeing from investors, that for sure is a shift from academic premia into other styles. And that's back to, I don't remember who made the comment that the pharma French factors sort of had a challenging time. Investors are realizing that, and they're sort of trying to find other themes or other strategies and move quite quickly. So we see a shift from academic premia into different things like machine learning, I've mentioned it, risk management, how do you control the allocation to your different strategies, how do you allocate to your different strategies, controlling for all sorts of biases, defensive portfolio bond replacement, and we see a lot of quant techniques being used to construct thematic baskets, what is known as thematic baskets. So how do you trade inflation in the market at the moment? How do you trade the zombification of the economy? And something that is keeping quants very busy, ESG. So I know it's coming in the US. It's very present in Europe, but there are a lot of questions in terms of portfolio construction, asset prices, asset valuations through the prism of SRI, so sustainable investment and ESG investments. So that's clearly a way of development and a way of innovation for the quant community. That was my conclusion.
Okay. All right. Thank you very much. All right. That's great. Well, this was a fantastic end to the BQE spring seminar. And I just mentioned that the recording will be on YouTube in a week. And if any of you want the slides, they were distributed earlier, but if you didn't get them, just email me on pc73@nyu.edu or look up my name, you'll get my email address and I'll reply with them. Okay, thanks very much, everyone. Have a great summer and hope to see some of you back in the fall.
Thank you,
Thank you,
Peter.
Sandrine.
Thank
wonderful,
you.
wonderful talk. Thank you very much.
Thank you.
Have a good day.
Bye.
Bye-bye.
Bye all.
Bye.
Cheers.
Yeah,
Bye.
thank you.